you're an aspiring trader, someone aiming to become a confident investor or active market participant, then you've come to the right place. At Trade to Prosper, we equip you with the essential trading education, starting with core concepts and gradually elevating your understanding as you become familiar with the methodology. As an aspiring trader, your journey begins with mastering foundational trading concepts. The more you understand these ideas, the clearer the market becomes and the better your decisions will be. Successful traders don't just study concepts in isolation, they learn how to connect them. This is the art of confluence and structured decision making. Each concept is a piece of the larger puzzle. True mastery comes from knowing when to apply them, how they interact, and why they matter in different market conditions. In this module, our goal is to give you a complete overview of the core trading concepts we believe every aspiring trader must understand, regardless of where the market is in the price cycle. Whether it's trending up, trending down, or moving sideways, our approach is designed to work across all market conditions. Since this is an introductory video, we'll give you a concise, point-form rundown of what we cover in the full program. This will help you get a clear sense of our training content and how it compares with others in the space. From our experience, what we offer goes beyond most courses available today. Each module is tailored not only to explain a trading concept, but also to show you what type of trader it's suited for and where in the price cycle the strategy is most effective. That clarity gives you a significant edge. So let's begin with a high-level overview of the 5 key stages every trader must go through to become a skilled and competent market participant. Now let's look at stage 1, the foundational market understanding. The foundational stage, or first stage of the concepts, lays the groundwork for your trading journey. These are essential trading concepts that form the backbone of any trading market analysis. Based on our experience, we have the concepts in priority sequential order to help you build a strong foundation. Now, here's a rundown of the key points of stage 1 and its individual concepts. Concept 1. Candlesticks. Candlesticks reflect price action over time and help you read market sentiment. You'll learn to identify patterns that hint at reversals, continuations, or indecision in the market. Candlesticks tend to help find entries to trades as well as tell what is happening as it reaches support and resistance levels. Hence, concept 2 is appropriately aligned, called support and resistance levels. Support and resistance levels are foundational to technical trading. They mark key price zones where the market has historically reacted, either reversing or stalling. Studying these levels helps traders identify high probability areas for entries, exits, and setting stop losses, making them critical for planning and managing trades effectively. We have 8 methods to find support and resistance levels, and many of them are part of the Stage 3, intermediate to advanced concepts. Concept 3, liquidity and stop hunts. Understanding liquidity means recognizing where orders cluster, especially stop losses and pending entries. Markets often seek out these zones, leading to fake outs, stop hunts, and sudden price spikes. Learning how liquidity works helps you avoid common traps, anticipate sharp moves, and position yourself on the right side of market intent. Concept 4. Trends and market structure. Understanding trends helps you align with the market instead of against it. You'll learn to distinguish between trending and ranging conditions so you can apply the right strategy at the right time, whether the market is moving directionally or consolidating. This also is divided into 2 parts. Much of this concept is also aligned with Elliott wave theory, also in stage 2 and 4. Concept 5. Consolidation and breakouts. Markets often move sideways in range-bound conditions. Learning to identify consolidation zones, volatility compression, and potential breakout points is essential. This helps you with timely entries more precisely, manage risk effectively, and avoid false breakouts that are crucial for range trading or investing strategies. Concept 6. Chart structure and market phases. We introduce the concept of market cycles and chart structure, accumulation, expansion, distribution, and reaccumulation. This forms the basis for anticipating where price is headed next. Concept 7. The types of traders and styles. Before you choose your tools, you need to know what type of trader you are or want to become. We break down the different trading styles, scalper, day trader, swing trader, position trader, and help you align with one that suits your lifestyle and psychology. Stage 2, The strategic tools and analysis concept is about enhancing your understanding of market behavior. Here, we dive into the core tools and indicators that will sharpen your ability to read market behavior, spot high-probability opportunities, and make more confident, informed decisions. These 7 key concepts form your essential toolkit for decoding market momentum, sentiment, and trends. Mastering them will give you a real edge in navigating different market conditions and trade setups. Let's break them down. Concept number 8, moving averages. Your trend compass. Moving averages are foundational tools that help you determine trend direction, as well as identify dynamic support and resistance. They smooth out price fluctuations, making it easier to see the market's underlying direction or bias. You'll learn which moving averages are best suited for different timeframes, how to use them as trend filters, how to combine them with other tools for added confluence. Simple but powerful, moving averages are your go-to guide for understanding trend behavior. Concept number 9, Fibonacci retracement. Fibonacci tools are used to measure potential pullback levels during corrections, helping traders anticipate where price may pause, reverse, or continue. These levels frequently align with significant support and resistance zones, making them highly effective for planning entries, exits, and profit targets. You'll learn the logic behind Fibonacci retracement and how to identify high-probability reaction zones. Set clear entry and profit-taking levels. Use it alongside market structure and price action. When applied correctly, Fibonacci adds precision to your strategy. Concept number 10, indicators. Indicators are mathematical tools that analyze price and volume data to highlight key market dynamics such as momentum shifts, trend strength, or potential reversals. While not predictive on their own, indicators, when used selectively and purposefully, can strengthen your trade setup through confluence. We focus on practical application, helping you avoid clutter and stay focused on what matters most. Concept number 11, divergence and convergence. Divergence occurs when price and an indicator move in opposite directions, often signaling a potential reversal or loss of momentum, a reversal. In contrast, convergence happens when price action and indicator movement align, helping to confirm trend strength. Learning to visually identify divergence helps you spot early warnings before reversals, confirm or question trend continuation, add a deeper layer of confluence to your analysis. Mastering this concept makes your analysis more complete and anticipatory, not just reactive. Concept number 12, volume and market profile. Volume and market profile tools give you insight into where market participants are most active. By analyzing volume spikes, volume nodes, and value areas, you'll be able to detect areas of strong buying, selling interest, identify hidden support resistance zones, understand market sentiment and participation zones more clearly. Tools like the volume profile and market profile provide structure to your chart, helping you read auction dynamics and institutional behavior more effectively. Concept 13, fair value gaps and imbalances, price inefficiencies, uncovered. Fair value gaps and imbalances refer to areas on the chart where price moved too quickly, leaving behind a gap or an inefficient fill of orders. These often include CME gaps, it's common in Bitcoin and futures markets, institutional imbalances, sudden directional moves without much volume or structure. You'll learn how to spot fair value gaps and imbalances, why price often returns to fill these inefficiencies, how to use them as entry, exit, or target zones, why it matters. These levels act like magnets for price, often providing high-probability trading opportunities when used with structure, order flow, or momentum confirmation. And the last concept in this stage is Concept 14, Elliott wave theory. Elliott wave theory is based on the idea that markets move in predictable wave patterns driven by crowd psychology. While advanced in its full form, this concept module introduces the foundational wave structures. You'll learn the difference between impulse waves and corrective waves, basic wave count rules and guidelines, how to identify common wave structures in real time, why it matters. Understanding wave structure helps you anticipate market cycles, recognize the maturity of a trend, and forecast possible continuations or reversals with a higher degree of confidence. It's especially useful for longer-term swing or positional analysis. Now moving on to stage 3, intermediate to advanced tools concepts. This stage is probably the one that brings it all together in terms of concepts and trading strategies. Stage 3 adds deeper context and precision to your analysis and therefore better entries or finding more trade setups. Hence concept 15, patterns, high-precision structure recognition. Patterns on charts can be recurring price formations that reveal underlying market psychology. From harmonics to Elliott wave structures, these setups offer insight into potential reversals and continuation zones. What you'll learn is the following: how to identify harmonic patterns like Gartley, bat, crab, butterfly, and shark, the basics of Elliott wave patterns, pattern logic and the importance of symmetry and fib ratios, why it matters. Advanced pattern recognition can provide precise entry and exit points in the market, especially when combined with confluence and structure. Moving on to concept 16, liquidity pools and liquidity hunts. Liquidity pools represent clusters of pending orders, such as stop losses or breakout triggers. Liquidity hunts, often initiated by institutions or large players, are moves designed to sweep these zones before reversing. What you'll learn is the following: how to identify common liquidity pools and stop-loss zones, recognizing the signs of a liquidity hunt, how to position around these traps instead of being caught by them, why it matters. By understanding how and where price targets liquidity gives you an edge in avoiding false breakouts and trading with the smart money, not against it. Next is concept 17, smart money concepts, trade like institutions. What it is: SMC is a framework based on how institutional traders interact with the market. It focuses on price structure, liquidity, and order flow rather than traditional retail patterns. What you'll learn: key concepts, order blocks, breaker blocks, inducement, BOS, break of structure, and CHOCH, change of character, how to spot accumulation and distribution zones, how institutions manipulate price to build or exit positions, why it matters. This perspective aligns your analysis with institutional behavior, helping you trade from a position of understanding rather than reacting to price. Concept 18, order flow and DOM, real-time market insight. What it is: order flow and DOM, depth of market, offer a real-time view of buying and selling pressure through tools like the order book, footprint charts, and open interest. What you'll learn is the following: how to read the order book and DOM ladder, interpreting footprint charts and volume deltas, using open interest for futures positioning, why it matters. These tools give you a deeper understanding of market participation, helping you time entries with more precision and read the intent behind price movements. Moving on to concept 19, gathering statistics, building your edge with data. By tracking statistics, then the process of recording trade outcomes, setups, and repeated price behaviors to uncover repeatable patterns and optimize performance can increase your success rate. What you'll learn is the following: how to track key levels like Fibonacci retracements and extensions, and find what common levels align with Elliott wave counts, recording your setups across different conditions, turning data into a refined trading edge, why it matters. By gathering statistics, you remove guesswork from your trading. Over time, you'll develop a data-backed approach that builds consistency, confidence, and accountability. Stage 4, theoretical depth. In this stage, you'll begin to explore structured models of price behavior and advanced market concepts that require deeper focus and commitment. These theories explain why markets move the way they do and help you anticipate what might happen next. We'll pair the theory with live chart examples, helping you internalize the concepts and apply them in real trading environments. Let's explore the key concepts that bring greater depth to your understanding of market mechanics. Therefore, we look at concept 20, price cycle. The price cycle is the natural rhythm of the market, often described in 4 phases: accumulation, markup, distribution, and markdown. These phases reflect the psychology and actions of major players and how they influence price development. What you'll learn is the following: how to identify each market phase, core principles of Wyckoff theory, recognizing accumulation and distribution zones before major moves, why it matters. Understanding the price cycle allows you to anticipate transitions between phases, enabling better timing of entries and exits. It also sheds light on market manipulation, helping you avoid false signals and position with larger trends. Concept 21, Elliott wave theory with advanced concepts. Elliott wave theory suggests that markets move in repeating wave structures driven by collective crowd psychology. This concept breaks price action into impulsive and corrective waves, helping traders forecast potential future price paths. What you'll learn is the following: detailed wave structure and wave labeling, rules and guidelines of wave formation, how to anticipate wave completion and reversals, why it matters. Elliott Wave helps you develop a macro perspective on market movement, particularly in trending or corrective environments. It sharpens your ability to forecast long-term direction and recognize turning points with greater confidence. Concept 22. Trading strategies. This concept focuses on how to develop and apply trading strategies based on market context, including structure, timeframes, and phases. What you'll learn is the following: how to define levels of interest, LOIs, when and how to apply different strategy types, for example, breakout strategy, cradle strategy, ranging strategies, and so on. The importance of confluence when building a setup and what to look for, based on live examples. Why it matters. Having a toolbox of strategies allows you to adapt to various market conditions. You'll learn to select and apply the right method at the right time, improving your consistency and ability to manage risk effectively. Moving on to stage 5, which has a bunch of different areas of focus, and less to do with charts and more about your approach to trading. Hence we called it risk, psychology, capital, and going live. These concepts protect your capital and establish your trading framework. In this section, we go over the following concepts: risk management, trading psychology, leverage, paper trading. With the last concept, trading plan and journaling. Let's summarize what these concepts entail. Concept 23. Risk management. What you'll learn is the following: trading position sizing, stop-loss placement, risk-to-reward ratio, maximum drawdown, and account risk limits. It's important to protect your capital. Even a good strategy fails without solid risk control. Proper risk management ensures you stay in the game long enough to benefit from a profitable strategy. Concept 24. Trading psychology. Mastering the mental game. Trading psychology is the internal framework that governs your behavior, decisions, and discipline while trading. It's about managing your emotions, maintaining consistency, and making rational decisions under pressure. We will give you the steps to take control of your emotions, provide you on how to recognize and manage fear, greed, and FOMO, fear of missing out, demonstrate on the role of patience and discipline in long-term success, and what steps to take. We will give you a list of common trader behaviors and practical techniques to overcome them. Even with a solid trading strategy or setup, we can still have a failure in the trade, whereas poor emotional discipline can sabotage your performance and results needlessly. Psychology is the key separator between good traders and great ones. By mastering your mindset, you'll be able to stay focused, reduce impulsive decisions, and trade with greater clarity and consistency. Concept 25. Leverage, amplifying risk and reward. Leverage allows traders to control a larger position size with a smaller amount of capital at risk. While it can magnify gains, it also amplifies losses and increases exposure to market volatility. You will learn the difference between margin, isolated, and cross-leverage, how liquidation works and how to avoid it, the risk implications of using high versus low leverage, how to manage position sizing in leveraged environments. Leverage is a double-edged sword. While it can enhance returns, misusing it is one of the most common reasons traders blow their accounts. Understanding how to use leverage responsibly is critical to protecting your capital and maintaining long-term sustainability in trading. Concept 26. Paper trading and backtesting. Practice without risk. Paper trading and backtesting are methods used to simulate trading without risking real capital. Paper trading helps you build confidence in live-like environments, while backtesting allows you to test strategies on historical data to evaluate performance. You will be shown how to paper trade in simulated environments using the TradingView app, how to backtest strategies using historical charts, what to look for in a valid test result, how to refine strategies based on data and outcomes. By using these tools, it allows you to learn, practice, and tweak your approach in a risk-free environment. Whether you're new or experienced, they help build confidence, reduce emotional pressure, and validate your edge before putting real money on the line. And finally, Concept 27, Trading Plan and Journaling, Structure for Consistency. A trading plan outlines your strategy, rules, and risk parameters, while journaling involves documenting your trades to review performance and behavior over time. Together, they form the backbone of accountable, disciplined trading. Learn how to create a clear, actionable trading plan. Learn what to include in a trade journal. Learn how to track metrics like win rate, risk to reward ratio, and emotional patterns. And learn how using data to refine strategies and eliminate repeated mistakes. We cannot emphasize enough, especially for beginners, on how a well-defined plan keeps you aligned and focused, while journaling helps you reflect and improve. Without these tools, it's difficult to measure progress or correct recurring errors. They are essential for long-term growth, consistency, and professional development as a trader. This next category can be studied anytime. It's not really dependent on the 27 concepts we mentioned. It is something all traders should, at the very least, be familiar with, and ideally, study in depth. We call this macro awareness and fundamentals. Understanding macroeconomic influences and broader market dynamics allows you to incorporate external correlations into your trading strategy. This awareness can help you assess additional layers of risk that may not be visible from technicals alone. What we briefly discuss are the following: the US dollar index DXY chart, United States routine interest rate announcements and its likely movements, Bitcoin versus S&P 500 or SPX or gold correlation, and key global economic events. It's important to understand macro forces that can shape major market moves and trigger volatility. Having this perspective helps you anticipate larger market trends, cross-market correlations, or risk-off environments that can impact your trades, even when the technical setup looks perfect. The other is news events and fundamental drivers. In both traditional and crypto markets, fundamental events can be major price movers. This section outlines the key drivers we monitor regularly and what you should be aware of before entering or managing a trade. What we briefly discuss are the following: earnings reports for stocks, CPI, Consumer Price Index, FOMC, Federal Reserve meetings, crypto-specific news and updates, on-chain data, supply metrics, wallet flows, etc. Money flow chart as it correlates for institutional behavior, and ETF inflows, outflows. That brings us to the end of this presentation. We hope you found the information valuable and that it serves as a practical roadmap for your trading journey. Whether you decide to continue learning with us at Trade to Prosper or explore these concepts through other resources, our goal remains the same: to help you trade with purpose, structure, and efficiency. If you have any feedback or questions, please leave a comment in the YouTube comments section. We'd love to hear from you. Until next time, all the best, and bye for now.
There you have it. Please give Sam a like, share, and subscribe to his channel to support him for doing more.